Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. October's National Financial Planning Month. Financial planning, as we know it, includes investing, tax planning, retirement planning, and basically other ways to get your finances in order and create mindful budgets to ensure a safe and secure future. Getting a step ahead of your spendings and finances is beneficial in the long run, and Financial Planning Month is the perfect time to do that. Joining us for this segment, we have Professor James Choi with the Yale School of Management to discuss empirical research that finds popular financial advice often differs greatly from normative principles derived from economic theory. Professor Choi, it's great to have you with us. Welcome to Trade Talks.
Thank you. My pleasure to be here.
Yeah, and this is such an interesting piece that we're doing for National Financial Planning Month because we're looking under the hood at some of the philosophies behind advice that's given. What are the biggest differences between popular authors' advice and economists' recommendations?
I think the biggest difference has to do with savings over the life cycle. So the popular authors will tell you something that sounds very prudent. Save 10 to 15% of your income all the time, no matter what's happening in your life through thick and thin, no matter what your age is. And economists would actually have a very different perspective, where economists say it's better to have a consistent level of spending on yourself over time. And the idea is that the fifth slice of pizza is never as satisfying as the fourth slice of pizza, which is never as satisfying as the third slice of pizza. And so rather than scrimping and struggling in your 20s and maybe overindulging in your 40s, you should have a consistent level of spending on yourself in your 20s and 40s. And because your income is probably going to be lower in your 20s than your 40s, you can get away with not saving all that much in your 20s and then saving a lot in your 40s. And so this is a very different view of what prudent financial planning would be.
Well, I guess the obvious question is, which side is right?
I think that if you want to have a kind of easy, pleasant life, the economists are right. I do think that this principle of diminishing returns to spending on yourself does hold. That said, if you are the type of person who could not just flip on that savings switch when you're in your 30s and kind of change from somebody who is really spending almost everything they have coming in to somebody who is saving a large percentage of their income, if that's not you, then maybe it is useful to follow the popular advice and to build this discipline of saving, of always saving 10 to 15% of your income, living within your means, because maybe that's part of what kind of being the type of person who saves is all about, kind of being consistent in this habit.
What is the biggest misconception promoted by popular authors regarding investing?
I think the biggest thing I saw was this conception that in the long run, stocks always go up. That is just not true. Now, it has been true in the US because we've had a fantastic century. But if you look at the stock market in Japan or the stock market in Italy, it's been decades since they hit their last highs. So it just isn't true that over the long run, stocks always go up. Now, that said, the stock market is a pretty great investment. So I encourage people to be in the stock market, but just be aware that there are risks even in the long run.
Right. And when you think about the long run, what was the time frame that you examined? Because it could be arbitrary, but I consider long run and perhaps what you used in the research.
Well, what the popular authors look at is kind of 10-year horizons or 20-year horizons, where they say the stock market has always gone up over those 10-year or 20-year horizons historically in the US. You're talking about a century of data, and there aren't that many 10 or 20-year periods in a century of data. And so even within the US, I think we just had some pretty good luck over the last century.
What recommendation in the popular book surprised you the most?
You know, one thing that happens a lot in the US is you see people who have a bunch of credit card debt, but then they have a bunch of savings that are sitting around earning low interest, even though they could be using that savings to pay off their high interest credit card debt. Now, this seems like just a loss that is easily preventable. They should just pay down their high interest rate debt. But surprisingly, a lot of these popular authors recommend that even though you have all this credit card debt sitting around, you should have this buffer of saving that's earning low interest rates in your bank account. And the reason is that they say that if you are trying to pay down debt, you need to establish a personal rule that you will not borrow any additional amounts. And that means that if there's some bump in the road, you get a flat tire, or your roof needs patching or something like that, you have some savings with which you can meet that need instead of going and borrowing an additional amount. Their theory is that if you borrow that additional amount while you're still on this debt repayment plan, it's going to be so demotivating that you're going to get derailed and you're going to just come off of your debt repayment plan.
Well, it's so interesting, Professor Choi, because it almost goes back to your first point where we're looking at the differences between author advice and the economist. It comes back to personal discipline at the end of the day. If you think you can consistently save, or if you think it's going to be hard to turn on that light switch in your 30s, it sounds similar to the theory about continuing to save and not necessarily paying off all your debt. So it sounds more like personal discipline and lifestyle more than anything else.
I think that's right. It really comes down to a conception of what human nature is like and what human frailty and limitations are about. I think there's a lot of analogies to dieting, where the best diet is the one that you can stick with. And what academic economists, research economists, I think have not spent nearly enough time paying attention to is what kind of financial diet can we actually stick with? What are the things that are motivating and can build those disciplines over time? And the popular authors have some theories about what does work in that domain, but as far as I know, there's not a lot of scientific evidence that it works or that it doesn't work. And that's something I'd love to see more research on in the future.
Yeah, I certainly would too. I think the data sets are so interesting to see because of all the variables that go into it. Professor Choi, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.